For most of your life, Canada was the neighbor you never thought about. Not in a dismissive way, more like the wiring inside your walls. You don't think about it until something stops working. That assumption is now being tested, and the effects are reaching ordinary households across the United States. In electricity bills, in manufacturing jobs, in the cost of steel, and in the price of the cars people drive. This is a story about infrastructure, interdependence, and what happens when the most economically integrated partnership in modern history begins to unravel. The scale of that partnership is not widely understood. The United States and Canada conduct annual trade worth $1.3 trillion. Canada is the top export destination for American goods, $349.4 billion in 2024 alone, and the single largest import source for 22 individual U.S. states. But the relationship runs deeper than trade volumes. It was built on physical infrastructure designed from the ground up to function as one system. American refineries in the Midwest and along the Gulf Coast were engineered specifically to process Canadian crude. More than 30 major transmission lines carry electricity back and forth across the border daily, supplying homes and businesses in New York, Michigan, Minnesota, and New England. In 2023, the United States purchased $3.2 billion worth of electricity from Canada, enough to supply more than 5.6 million American homes. This integration was not accidental. It was the product of decades of deliberate policy. The 1988 Free Trade Agreement, NAFTA in 1994, and the USMCA, renegotiated by the Trump administration and ratified in 2020. Layer by layer, the two economies were woven together until separating them became, by most economic assessments, genuinely costly for both sides. That is the system that came under severe pressure beginning in early 2025. On January 20th of that year, Donald Trump returned to the White House and announced what he described as an America First trade policy. Within weeks, his administration imposed 25% tariffs on goods imported from Canada and Mexico, citing fentanyl flows and what Trump characterized as an unacceptable trade deficit. Critics noted that the vast majority of fentanyl entering the United States arrived through the southern border, not the Canadian one. The tariffs went forward regardless. Financial markets reacted quickly. On March 4th, the S&P 500 fell 1.8%, and the Nasdaq dropped 2.6%. By March 6th, the index had given back nearly all of its gains since the November 2024 election. The slower, more consequential effects took longer to surface. Within weeks of the tariffs taking effect, 54% of Canadian manufacturers reported direct impact. Canadian goods exports to the United States dropped more than 15% in a single month, April 2025, following a frenzied first quarter in which businesses rushed to ship inventory across the border before costs rose. That surge temporarily lifted Canadian GDP growth to 2.2% in the first quarter. The reversal, when it arrived, produced the largest Canadian export contraction since 2009 outside the pandemic period. 2 million Canadian jobs depend on goods exports to the United States. Manufacturing employment fell by 55,000 positions. Auto production declined 5.4% across 2025. When Stellantis announced it was moving a major plant from Ontario to Illinois, eliminating roughly 3,000 jobs, the Canadian government responded by restricting the company's access to certain domestic program benefits. Canada's formal retaliation came in 2 rounds: 25% tariffs on approximately $30 billion worth of American imports, followed by an additional round targeting U.S. steel and aluminum products. But alongside those broad measures came something more targeted. On March 10, 2025, Ontario Premier Doug Ford announced that his province was imposing a 25% surcharge on every megawatt-hour of electricity exported to Michigan, Minnesota, and New York. Ontario's grid exports enough power to supply 1.5 million American homes. The surcharge was projected to add up to 400,000 Canadian dollars per day in costs to American consumers and businesses, approximately $100 per month per affected household by Ford's own estimate.
His public statement was direct. "I will not hesitate to increase this charge," he said. "If the United States escalates, I will not hesitate to shut the electricity off completely. Until these tariffs are off the table, Ontario will not relent." The governors of New York and Minnesota protested formally. The Michigan Public Service Commission issued a statement citing both pricing concerns and grid reliability risks. New York Governor Kathy Hochul and Senate Minority Leader Chuck Schumer wrote to state energy agencies, describing the situation as economically harmful and dangerously short-sighted. Trump responded within 24 hours by announcing he would double tariffs on Canadian steel and aluminum from 25% to 50%. The surcharge held for 1 day. Ontario's grid exported 26,000 megawatt-hours to the United States during that period, and the province collected approximately $260,000 in surcharge revenue. Then U.S. Commerce Secretary Howard Lutnick called Ford directly. Lutnick agreed to renewed trade talks. Ford suspended the surcharge. The White House confirmed it would not proceed with the threatened tariff doubling, and both sides stepped back.
What the episode demonstrated, however, could not be walked back. The infrastructure to interrupt American electricity access exists, requires no new construction, and can be activated through an administrative decision. For 1 day in the spring of 2025, it was. Electricity, unlike most traded goods, cannot be stockpiled or easily redirected. It moves through fixed lines in real time. When a supply source is disrupted, grid operators face constrained options, and those options generally come with a cost that flows directly to consumers. The states most exposed to Canadian power supply, New York, Michigan, Minnesota, and the broader New England region, are also among the most industrially active in the country. The costs were already visible before any electricity disruption materialized. GM's chief executive, Mary Barra, stated in May 2025 that the tariffs would cost her company between $4 billion and $5 billion that year alone. Corporate profits for U.S. fabricated metal manufacturers, the companies that convert raw steel and aluminum into finished components, fell 30% between the fourth quarter of 2024 and the second quarter of 2025. Machinery manufacturers saw profits decline 13%. Electrical equipment and appliance manufacturers were down 11%. Economic modeling from the Center for Economic Policy Research projected that the full effects of the trade war could reduce U.S. real wages by 1.4% by 2028 and shrink GDP by approximately 1%. These figures do not remain in financial reports. When profits contract at that pace, companies reduce overtime, delay hiring, and eventually cut positions. The workers who depend on those jobs absorb the consequences before economic indicators formally register them. A survey of more than 3,300 Canadian small business owners conducted in August 2025 found that 63% reported higher expenses, 53% reported reduced profits, 48% reported lower revenues, and 42% reported supply chain disruptions. Only 7% reported any positive effect. These businesses supply the broader manufacturing and logistics networks that connect both economies. The trade war also reshaped Canadian domestic politics in ways that directly affected the course of negotiations. In early January 2025, the Liberal Party trailed the Conservatives in national polling by more than 20 percentage points. Canadian travel to the United States fell 40% compared to February 2024. A national poll found that 62% of Canadians planned to avoid traveling to the U.S. for the following year. Provincial liquor boards removed American products from shelves. Buy Canadian campaigns became a broad civic response. Mark Carney became Liberal leader in March 2025, called a federal election almost immediately, and won a minority government on April 28th. The central issue of that campaign was Canada's response to American trade pressure. In his post-victory address, Carney said, We are over the shock of the American betrayal, but we should never forget the lessons. The government that emerged from that vote had been elected on a mandate to hold firm. Trump acknowledged as much when he met Carney at the White House in May 2025, telling reporters, "I think I was probably the greatest thing that happened to him." During that same meeting, when Trump again raised the prospect of Canada becoming the 51st state, Carney responded, "As you know from real estate, there are some places that are never for sale. We're sitting in one right now." Having met with the owners of Canada over the course of the campaign, it's not for sale, won't be for sale, ever. The months that followed brought a pattern of escalation, partial retreat, and missed deadlines. In June 2025, U.S. tariffs on Canadian steel and aluminum doubled to 50%. Carney told the House of Commons that Canada was in intensive negotiations while simultaneously preparing retaliatory measures if those negotiations failed. The Canadian Labour Congress warned that 23,000 steel and 9,500 aluminum jobs were at immediate risk. A deal deadline was set for July 21, 2025. It passed without an agreement. Further deadlines followed with the same result. Sustained uncertainty carried its own economic weight. Businesses that cannot plan reliably tend to stop investing, which slows growth independent of any tariff directly applied to them. In late June, Canada's 3% digital services tax, a levy on revenues that major technology platforms earned from Canadian users, nearly ended negotiations entirely. The tax applied retroactively to 2022, and the first collective payment, estimated at roughly $2 billion, was due June 30th. On June 27th, Trump announced the United States would terminate all bilateral trade discussions over the tax. Canada rescinded it on June 29th, hours before the deadline. The revenue was abandoned to preserve the negotiating channel. Talks collapsed again in October 2025 after Ontario aired a television advertisement during the World Series featuring Ronald Reagan criticizing protectionist tariffs. Trump shut down negotiations in response. By late that month, Carney was preparing Canadians not for an imminent deal, but for a longer-term structural shift. In remarks ahead of the federal budget, he said, "The decades-long process of ever-closer economic relationship with the U.S. is over. Our strengths of being tied to America are now our vulnerabilities. Our economic strategy is to change rapidly." That shift is now reflected in trade data. The U.S. share of Canadian goods exports fell to 71.7% in 2025, the lowest level since the early 1980s before the original bilateral free trade agreement came into effect. Non-U.S. exports grew 17.2%, largely offsetting the 5.8% decline in U.S.-bound shipments. Foreign direct investment into Canada reached $96.8 billion in 2025, the highest annual total since 2007. Over 40% of UK investment filings in Canada that year involved acquisitions of Canadian software companies, as international investors began treating Canadian technology assets as a gateway into North American markets. Canadian direct investment into the United States, by contrast, fell to $26.6 billion, less than half of the $65.5 billion recorded in 2024. In March 2026, Carney traveled to India, Australia, and Japan to develop new trade relationships, signing a $2.6 billion uranium supply deal with India. He has formally committed Canada to doubling its non-U.S. exports over the next decade. There is a further dimension to this that extends beyond energy. The United States is entirely import-dependent for 12 of the 50 minerals the U.S. Geological Survey classifies as critical, and more than 50% reliant on imports for another 29. These materials underpin defense technology, semiconductor manufacturing, battery production, and clean energy infrastructure. Canada holds substantial reserves of many of them. According to the International Energy Agency, Canada's lithium reserves alone could supply roughly half of cumulative global demand between 2030 and 2050. Canada currently has 56 active critical minerals projects across its provinces and territories. The same logic that made electricity a point of leverage in early 2025 applies to these materials. The longer the trade relationship remains contested, the more incentive Canada has to develop supply agreements with other buyers, and the harder it becomes for the United States to secure reliable access when strategic need arises. As of early 2026, the USMCA is scheduled for formal renegotiation. The tariffs remain in place. In February 2026, the House of Representatives voted 211 to 211 to repeal them, with a small number of Republicans joining nearly all Democrats. The measure requires Senate approval and a presidential signature and faces a likely veto. It is an indicator of congressional unease, not a resolution. The Canadian economy, for all the disruption it absorbed, showed unexpected resilience in some areas. Per capita GDP grew for the first time in 3 years. Net foreign direct investment turned positive for the first time in more than a decade. But sectors directly targeted by tariffs contracted 3.2%. Manufacturing employment fell significantly. Communities tied to auto production and steel output in Ontario and other industrial regions absorbed losses that aggregate statistics do not fully capture. On the American side, fabricated metals, machinery, and automotive manufacturing recorded substantial profit contractions. The Federal Reserve's own survey of business conditions noted a material drop in cross-border tourism and spending in states along the Canadian border. A small business owner cited in Federal Reserve reporting noted that a single container of replacement inventory would now cost nearly $230,000 to land on U.S. soil. Fen Osler-Hampson, a professor of international affairs at Carleton University and one of Canada's leading analysts of the bilateral relationship, assessed the situation plainly at the close of 2025. We increasingly look like 3 countries going our own separate ways. The integrated system that took 60 decades to construct did not collapse in a single year, but it shifted in trade flows, investment patterns, diplomatic alignments, and the political assumptions that underpinned the relationship on both sides. Higher material costs pass through to finished products. Manufacturing uncertainty reaches workers before it registers in official data. Energy disruptions translate to household bills. These are not abstract policy outcomes. They are the downstream consequences of decisions made about a relationship that, for most of its history, was treated as self-sustaining. The last 2 years have demonstrated that it is not. Alliances and integrated infrastructure require consistent maintenance from both parties. Where that maintenance has been withdrawn, the effects are now visible in supply chains, in employment figures, in capital flows, and in the political calculations of a government that was elected in part on a mandate to reconsider the terms of the relationship entirely. Negotiations continue. The outcome remains unresolved. The costs on both sides of the border continue to accumulate.